Before a single nail is ever hammered into a new American home, billions of dollars have already quietly changed hands in the dirt.
Literally in the dirt, yeah.
Right. I mean, it is incredibly easy to drive past a new housing subdivision under construction and just see, bulldozers, some dust, maybe some orange cones.
Just a big empty field.
Exactly. But that freshly graded patch of land is the literal foundation of the entire U.S. housing market.
Yeah.
Because someone had to acquire that raw acreage, fight through the local zoning boards, lay all the subterranean pipes, and pave the streets long before a home builder could even think about pouring a concrete slab.
It is a massive, highly capital-intensive logistical puzzle, and it happens completely out of sight of the eventual home buyer.
We tend to just focus on the name on the sign in the front yard, right?
Right.
The home builder.
Well, naturally. But the upstream process, preparing that raw land and transforming it into a fully buildable lot, that is where the real financial machinery operates. If you want to understand the current housing shortage or, where the broader real estate market is headed, you have to look upstream at the companies actually preparing the ground.
And that is exactly our mission for this deep dive. Today, we have a stack of financial documents, specifically the official fiscal 2026 third quarter earnings release and consolidated statements for Forestar Group, Inc.
Which just ended on June 30th, 2026.
Right, and Forestar is one of the leading national residential lot developers in the country. So we are going to unpack these financials to discover exactly how a company selling the literal ground floor of the American dream is navigating what, everyone agrees is a very tricky housing market right now.
Because Forestar acts as a crucial leading indicator. The challenges they face with land acquisition, local regulations, development costs today, and how they perform financially despite those headwinds, well, that tells us exactly what the consumer-facing home builders will be dealing with tomorrow.
Okay, let's unpack this because right out of the gate, there is a glaring contrast between the broader economic narrative and what is actually on this income statement.
Oh, absolutely.
Like if you read the financial news or listen to the Federal Reserve, the housing market right now is currently defined by, and I'm actually quoting the report's own forward-looking statements here, continued affordability constraints and cautious consumer sentiment.
Consumers are definitely feeling the pinch.
They are. And yet, Forestar just posted incredibly robust top and bottom line growth.
Yeah, let's look at that top line growth first. So, for the third quarter of fiscal 2026, their consolidated revenues hit $407 million.
Wow.
Yeah, that is a solid 4% increase from the exact same quarter in fiscal 2025. But the real story is how much of that revenue they're actually keeping.
Right, their net income. So the profit they actually take home increased 9% to $35.9 million, which translates to about 70 cents per diluted share.
Mm-hmm.
And if we move up a line, pre-tax income is up 12% to $48.7 million. I mean, they are operating with a pre-tax profit margin of 12%.
Which is incredibly healthy.
So revenues are up, but profitability is outpacing revenue growth significantly. How does that work?
Well, the underlying driver of that margin expansion becomes really clear when you look at the physical volume of what they sold. So in this third quarter, Forestar sold 3,659 lots.
Okay.
In the exact same quarter last year, they sold 3,605 lots.
Wait, so the physical volume of lots changing hands basically barely budged.
Right, a 1% increase.
They essentially pushed the exact same amount of product out the door as last year, but walked away with 9% more net income. I look at this kind of like a bakery. If I sell exactly one more cake than I did last year, but my profits jump 9%, I'm either pricing my cakes way higher or my kitchen is operating with ruthless efficiency.
That's a great way to put it. And the data in the consolidated statements reveals the mechanism here. The average sales price per lot increased to $108,800.
Wow.
Up from $106,600 in the prior year. So that extra $2,000 per lot spread across roughly 3,600 lots, that drops straight to the bottom line.
It demonstrates substantial pricing power in a market where you wouldn't necessarily expect to find it. I mean, I look at this business model almost like a semiconductor foundry. Like TSMC doesn't sell you an iPhone, right? Mm. They manufacture the highly complex, expensive silicon chips that Apple needs to build the phone.
That's exactly it. Forestar is manufacturing the chip.
Right. The fully entitled, developed lots that home builders absolutely require to build their product.
Yeah.
But here's where the logic gets strained for me. How is extracting a higher price per lot sustainable right now? You have inflation driving up material costs, interest rates are elevated, and the end buyer, the family looking for a 3-bedroom house, is completely maxed out. If the home builder can't raise the price of the final house without killing demand, how long can Forestar keep squeezing higher prices out of the dirt?
Well, that tension is the central problem in real estate development today, but Forestar's management is highly aware that they can't just blindly hike prices and flood the market. The commentary from their chairman, Donald J. Tomnitz, explicitly outlines their methodology. He emphasizes aligning the pace and price of lot sales with the timing of our investments and market demand.
Aligning the pace and price, so they are deliberately throttling supply.
Yes, it is a masterclass in controlled supply. Land development is incredibly susceptible to boom and bust
Oh,
cycles.
for sure.
Developers often get over-leveraged. They develop too many lots at once just to generate cash flow, and then they end up having to slash prices to clear inventory when demand dips. Forestar is doing the exact opposite.
By carefully managing when a finished lot comes to market, they maintain scarcity.
Exactly. They are maximizing the margin on every single project, rather than just chasing raw volume.
But to execute a strategy of controlled supply like that, you need absolute confidence that someone is going to buy the lot when you finally decide to sell it. Which brings us to, frankly, the elephant in the room, the core structural dependency of this entire company. We need to look at who is actually writing the checks for these $108,000 lots.
Right, because Forestar is not operating as an independent merchant developer pitching their lots to dozens of different regional and national builders every quarter. They are a majority-owned subsidiary of D.R. Horton.
And for you listening who might not track home builder rankings, D.R. Horton has been the largest home builder by volume in the United States every single year since 2002. They are an absolute juggernaut.
A juggernaut. And the financial entanglement between these two companies is staggering. Look at Forestar's pipeline. As of June 30th, 2026, Forestar had 23,500 owned lots under contract to be sold. That represents roughly $2.3 billion in guaranteed future revenue.
$2.3 billion in backlog. That's insane.
It gets crazier. Out of those 23,500 lots under contract, 21,800 are going directly to D.R. Horton.
Wait, really?
Yes, only 1,700 are contracted to outside customers.
And it goes even deeper than just the signed contracts. The report notes that another 19,200 of Forestar's owned lots are subject to a right of first offer to D.R. Horton.
Right.
So D.R. Horton essentially gets the first right of refusal on tens of thousands of additional lots before Forestar can even entertain another buyer. You can see this playing out in real time in the Q3 sales data. Out of the 3,659 total lots sold this quarter, Forestar sold a grand total of 289 lots to customers other than D.R. Horton.
Yeah, and that external sales number is actually down from the prior year. The gravitational pull of D.R. Horton's demand is just consuming almost their entire output.
From an investment analysis standpoint, isn't putting over 90% of your revenue into one single customer incredibly dangerous?
Yeah.
I mean, Forestar looks less like a publicly traded independent lot developer and much more like D.R. Horton's internal land bank.
It definitely looks that way.
Their report's own forward-looking statements section explicitly flags the effect of D.R. Horton's controlling level of ownership on us as a major risk factor. If D.R. Horton miscalculates the housing market and suddenly stops building, Forestar is left holding the bag on thousands of acres of dirt.
It is a highly concentrated risk, which is exactly why the SEC requires them to highlight it in the filings. But we have to evaluate the other side of that coin, too. This is a highly engineered, symbiotic relationship designed to solve the biggest problem in real estate.
Capital inefficiency.
Exactly. Think about the logistics of land development. You are buying huge tracts of raw acreage. You have to navigate local zoning boards, environmental regulations, and install millions of dollars of infrastructure, water, sewer, power, paved roads. This takes years and requires massive, continuous upfront capital outlays.
And raw land doesn't generate income. It just sits there, bleeding money through property taxes and interest payments on the debt used to buy it, until it is finally sold as a finished lot.
Right. It is an incredibly risky, speculative business if you don't know who is going to buy the finished product at the end of a 3-year development cycle. But Forestar isn't speculating.
Because of that backlog.
Exactly. That $2.3 billion in contracted future revenue from D.R. Horton acts as an enormous financial anchor. It completely de-risks their massive land purchases. They are simply executing a defined pipeline for the largest builder in the country, which explains how they are achieving a highly stable return on equity of 9.6% over the trailing 12 months.
Okay, but what does D.R. Horton get out of this? Why don't they just buy the land and develop it themselves? They certainly have the capital to do it.
Because D.R. Horton wants to focus entirely on vertical construction building and selling houses as fast and efficiently as possible, they do not want to tie up billions of dollars of their own capital for years in raw land development. It drags down their own return on capital metrics.
Ah, I see.
So Forestar takes on that specialized development role. They absorb the multi-year capital burden, but with the safety net of knowing D.R. Horton is obligated to take down the finished lots when they are ready.
There's actually a fascinating operational detail in this report that proves just how far this risk transfer goes. The report discusses transactions involving lot bankers.
Right, the lot bankers.
For the first 9 months of fiscal 2026, Forestar sold 1,094 lots to customers other than D.R. Horton. But it explicitly notes that 146 of those lots were sold to a lot banker who expects to sell those exact same lots back to D.R. Horton at a future date. And last year, they sold 693 lots to a lot banker destined for D.R. Horton.
Lot banking is a perfect example of the financial engineering required in modern real estate. Lot banker is essentially just a third-party financial entity. Forestar sells the lot to the banker, recognizing the revenue today.
So they get paid now.
Exactly. And the banker holds the lot on their balance sheet, absorbing the carrying costs like the taxes, the interest, until D.R. Horton is ready to build a house on it next quarter or next year. It keeps the debt off D.R. Horton's books and generates immediate cash for Forestar. It further cements that Forestar's entire operational model is designed around managing D.R. Horton's capital efficiency.
But if your entire business model is tethered to one mega builder in a notoriously cyclical industry, how do you protect yourself if a sudden severe macroeconomic shock happens? I mean, even with guaranteed contracts, if the housing market completely freezes, a lot of developer is highly exposed.
That brings us to the balance sheet, which is arguably the most impressive part of this earnings release. They have built an absolute fortress around their financial position.
Yeah, they really have.
Forestar ended the quarter with $1.1 billion in total liquidity.
$1 billion in liquidity. The breakdown shows $394.9 million in unrestricted cash and cash equivalents, plus another $669.9 million available on their revolving credit facility.
Right. And while they do carry debt around $793.8 million, the structure of that debt is highly defensive.
How so?
There are absolutely zero senior note maturities in the next 12 months. They do not have a ticking clock forcing them to refinance hundreds of millions of dollars of debt in today's higher interest rate environment.
And the metric that really tells the story of their leverage is their net debt to total capital ratio. It is sitting at an incredibly low 17.7%. Not to mention, their book value per share increased 10% year over year to $36.40.
A 17.7% net debt to total capital ratio is extremely conservative for a land developer. It means the vast majority of their financing comes from equity, not debt. Once you factor in their cash reserves, they're highly deleveraged.
Wait, holding nearly $400 million in straight cash right now seems counterintuitive, doesn't it? In an inflationary environment, cash loses purchasing power every single day. If you have a $2.3 billion guaranteed pipeline with the biggest builder in the country, why are you sitting on a mountain of cash? Why not deploy that capital immediately to buy up more raw land and accelerate growth?
Look at the specific macroeconomic risk factors management highlights in this release. They explicitly point to supply chain shortages, specifically the acquisition of land, construction materials, and skilled labor.
Oh, right.
Holding that cash is a calculated defense mechanism against an unpredictable supply chain. If municipal zoning approvals suddenly take an extra 6 months, or the cost of grading equipment spikes, Forestar has the cash buffer to absorb those delays without defaulting on their operating loans.
So it prevents a temporary logistical delay from turning into a structural financial crisis.
Exactly. And more importantly, that $1.1 billion is an opportunistic war chest. The chairman's statement makes their long-term intent very clear. He states, "We expect to continue aggregating market share, supported by our financial strength."
Aggregating market share.
Yeah. In a high interest rate environment, the smaller, highly leveraged local land developers, the ones who don't have D.R. Horton backing them, they are going to hit a wall. When their debt matures and they can't afford to refinance, or they just run out of cash trying to push a subdivision through environmental permitting, they will be forced to sell off raw land at a discount.
Wow. Okay. So Forestar is just waiting for the weak hands to fold.
Hmm.
They have the $1 billion ready to swoop in, buy up distressed land assets from over-leveraged competitors, and feed them into the D.R. Horton machine.
It is a predatory, highly effective strategy, and it's only possible if you maintain an aggressively deleveraged balance sheet during the good times.
This robust balance sheet and massive pipeline sets up a very interesting dynamic when we look at their forward guidance. What is Forestar expecting for the rest of the fiscal year?
Well, we have to analyze their total lot position to understand their pipeline. As of June 30th, they control an immense 91,700 lots.
That is a lot of dirt.
It is. The report breaks this down into 62,200 lots that they outright own and 29,500 lots that they control through land and lot purchase contracts.
But there is a massive caveat buried in those numbers. Of those 62,200 owned lots, only 9,600 are considered fully developed.
Right. That means the streets are paved, the utilities are connected, and they are ready for a builder to pull a permit and pour a foundation today. Only 9,600 out of 62,200. The vast majority of their owned assets are in various incomplete stages of development.
And this leads to a glaring tension in the report regarding their sales velocity. Because for the first 9 months of fiscal 2026, the total number of lots sold actually decreased by 9%. They sold 8,541 lots year to date, compared to 9,349 lots in the same 9-month period last year. So sales volume is down significantly over the year. Yet despite that 9% drop, Forestar is firmly maintaining its full-year guidance.
They are.
They are telling investors they still expect to deliver between 14,000 and 14,500 lots for the year, generating $1.6 billion to $1.7 billion in revenue. How could management be so confident in hitting those massive end-of-year targets when they're currently running at a 9% volume deficit?
This speaks to the unique timeline of real estate development and revenue recognition. You have to remember, land developers are not selling consumer retail goods. A 90-day earnings cycle does not reflect current market demand the way it does for a company selling, electronics or apparel.
Right. You can't just run a Black Friday sale on raw acreage to temporarily juice your Q4 numbers.
Exactly. That $2.3 billion in contracted future revenue acts as a massive shock absorber. The lots being delivered and paid for today, the ones showing up as revenue in this Q3 earnings report, were negotiated and contracted quarters, if not years ago.
Oh, I see.
Forestar can maintain its full-year guidance because they already hold the signed contracts. They aren't hoping 14,000 buyers magically appear in the fourth quarter. They already know exactly which subdivisions are scheduled to be finished, permitted, and handed over to D.R. Horton before the fiscal year ends.
So a 9% slowdown in lot sales over a 9-month period doesn't necessarily mean housing demand has evaporated. It could simply be a logistical bottleneck like a delay in getting final paving approvals in a few key municipalities, which just pushes the revenue recognition from Q2 into Q4.
Precisely. They are just working through a pre-scheduled multi-year pipeline. Their quarterly revenue is dictated by the physical delivery schedule of a pre-sold, highly regulated asset. It's not based on day-to-day fluctuations in consumer sentiment.
That structural lag is the immense power of their business model, assuming, of course, the buyer on the other end of the contract remains solvent.
Always the caveat.
Right. So to pull all these threads together, Forestar Group is executing a highly disciplined, controlled supply strategy in an otherwise very volatile sector. They are not trying to be an independent vendor to the entire market.
No, none at all.
By engineering a deeply symbiotic relationship with the nation's largest home builder, and by aggressively fortressing their balance sheet with over $1 billion in liquidity, they are managing to expand profit margins and grow their book value despite serious macroeconomic headwinds. They are insulated from immediate retail risk by acting as a dedicated, specialized supplier to a massive partner.
It demonstrates that in heavy industry and real estate, the most profitable position isn't always selling the final product to the consumer. Sometimes, the most secure returns are found in controlling the fundamental supply chain, the raw materials, that the rest of the industry desperately needs to function.
Absolutely. So the next time you find yourself stuck in traffic next to a sprawling new residential subdivision being carved out of a hillside, you will know that you aren't just looking at heavy machinery moving dirt around. You are looking at a highly orchestrated, multi-billion-dollar financial apparatus that requires years of capital planning, massive cash reserves, and strategic corporate partnerships,
Yeah.
long before a single for sale sign ever goes up in a yard.
It's a whole world out there.
It really is. But there is one final, lingering detail embedded in these sources that I want to leave you with, something to mull over regarding the future of the housing market. We noted earlier that out of Forestar's 62,200 owned lots, only 9,600 are fully developed.
Right.
That means there are over 52,000 lots sitting in various incomplete stages. Raw acreage, unpermitted phases, half-finished streets. Think about the logistics of that for a second. If macroeconomic conditions shift rapidly, say inflation cools dramatically, the Federal Reserve executes a sudden massive drop in interest rates, and the market is instantly flooded with eager homebuyers who can suddenly afford a mortgage again.
Which everyone is waiting for.
Exactly. Will that massive backlog of undeveloped land be a competitive advantage? Will Forestar be able to quickly cash in on that explosive demand? Or, because the physical development of land takes years of permitting and construction, will all that half-finished dirt act as a slow-moving anchor, holding back their ability to actually supply builders when the market suddenly needs houses yesterday? It is a fascinating tightrope, and it proves that in the business of building communities, timing isn't just everything, it's the only thing.